So today we are going to talk about our lecture 1 for chapter 1. It is an introduction. I would very much appreciate if you have your lecture notes available to you while you are watching this video, because it will help you make some notes. Maybe not for the chapter 1, because chapter 1 is mostly an introduction of what you have already covered during accounting 2301, the introduction to financial accounting, and there are not much calculation going on in this chapter, and I will try to do another video for calculation if there needs to be. So we'll start our lecture today. So the first thing is, what is business? So when we are talking about a business, we always thinking in terms of for-profit entity. Any business, whether big, small, or medium size, that is involved in providing either a product or a service to the customers, and in doing that they're going to incur some expenses and earn revenue, and the difference of revenue and expense, either they're going to be profitable or they're going to be at loss. So any entity, so it says organization, enterprising entity engaged in commercial, industrial, or professional activities. So if we look in terms of what we call it, if we are providing a product, so the product could be like Dell computer or Apple iPhone. But we are talking about professional activities or services firms. We are talking about a doctor's clinic, a lawyer's office, an architectural office, an accounting office that's providing you those services. So what is accounting and how accounting is associated with the process, with business? So accounting is basically a record keeping. So in a business, before you start to serve your own customers, whether you are providing a product or a service, you have expenses in which you are either developing the business or you are establishing a business. So what accounting does, accounting helps you keep track of all the transactions. So what is a transaction? A transaction is basically a unit of business. Means when you are selling your service or product, you are earning something, which is your revenue. When you are incurring expenses, such as you are paying rent, you are paying salaries, you are paying utilities expense, you are purchasing inventory, these are your expense, and we're going to keep track of all those expenses. Other transaction, you could be lending money, you could be borrowing money, there are investors who are investing money in your system, and there are things either you are buying it or leasing or renting it. So all of those are transactions that needs to be recorded. So once those transactions are recorded at the end of the month or at end of the quarter or every 6 months or every year, we like to provide a report. And that report is called a financial statement, such as income statement, balance sheet. Those reports provide us how much revenue we have earned, how much expenses we have earned, how many assets we have, what are our liabilities, means what we owe to our other people. And when we take a difference between asset and liabilities, how much equity or how much the business we own. So that's accounting in a nutshell. And this information help us make decisions about what we want to do with this business, and then we will discuss these things. So why accounting is important? Accounting is important because it's an information system. It provides a basic information about business. It measures business activities, means it tells us how much revenue we have earned and what expenses we have and what we can forecast for the future, based on what we have currently. So, and it's processed the information into a report, as I said, like a report such as income statement, balance sheet. Accounting is the language of business, of course, because these financial statement documents are very, very important. They are important because these documents helps make future decisions. So for example, after establishing your business for 2 years, you go to the bank and you want to expand your business, but you need $100,000. So the bank would like to know how long you've been in the business, who prepares your financial statement, who files your tax return, who files your sales tax return. So how many employees you have, what kind of a employee or payroll taxes you are paying. So you have to provide all this information. You have to provide your financial statement through your CPA, your tax returns. I mean, tax returns, when I'm talking about your annual federal tax returns, if you have any state tax returns, your sales tax return, your employee tax return. So all of those things you're going to provide them in order for them to make a decision. The same way, if you're not borrowing the money, if you are asking money from your friends and family members and neighbors to invest in your business, they would need those financial statements to make a decisions whether they want to be part of your business or not. Okay. The next thing is accounting process. Accounting, when we're talking about the accounting process, is a measure of economic activity. When we are talking about economic activities, this is the formal or a sophisticated word for business activity. Business activity simply means selling, purchasing, hiring, firing, lending, borrowing, producing, providing. All of those things is business activity. So who uses accounting information? Accounting information is basically individuals. They could be investors, it could be creditors, it could be regulatory bodies and non-profit organizations. So for example, regulatory bodies. I just mentioned that the bank would like to see how much sales tax you have pay or collected on behalf of the state of Texas, and then pay them back every quarter or every month. So these regulatory bodies, one is the state sales tax office in the state of Texas, for example. The second is federal IRS for federal tax. And if they are paying any state tax, even though we do not have a state income tax in is the state of Texas, but there are some other tax that the businesses pay to the state of Texas, which is a complicated issue I'm not going to discuss here. So these are the regulatory body. Investors and creditors, for example, creditor is your bank who's loaning the money. Investors are the people who are buying shares or pieces or part of your business. Non-profit organizations may interested because non-profit organization runs on donations. So if they found there is a local business that's doing very well, they would like to read the financials and say, okay, I can ask few $1,000s for from this business. So that's why nonprofit organization may be interested in it. Now, accounting information has two basically users basically, and it's used. They are external users and internal users. And external users are obviously investors, means shareholders. Creditors means banks. Regulators means state tax authorities, sales tax authorities, federal income tax authorities. Internal users are management, the finance department, human resource. So why management need? Because management needs to make a decision. So for example, if you are sitting on too much inventory, we really do not need to buy inventory. We need to find out ways to sell inventory to make, and other decisions such as hiring and firing means what is our busy season. As you know, from Thanksgiving all the way to New Year's, we have a really busy business season. So a lot of people hire temporary people. So you want to know, sometimes restaurants, for example, restaurants would like to hire extra help on special days, Father's Days, Mother Day, other during what we call it a month of May, where we have a lot of graduation parties. So restaurants want to make sure they hire enough people. So these are the things that helps them make business decisions. The next thing we're going to talk about is two kinds of accounting. So you have already taken two courses, most likely. One is Accounting 2301, which is financial accounting. Accounting 2302, which was managerial accounting. Financial accounting is important because that provides the financial information reports such as income statement and balance sheet, a statement of cash flow, statement of retained earnings to investor, creditors, and government agencies. The managerial accounting is important because we have to make internal decisions. So we talked about in accounting 2302 about cost and budget. So they were two. So how much should I charge for my service or product? That's one issue we discussed in managerial accounting. The second issue was budgets. So what is our expected sales? So suppose if we're going to sell $1 million of our service or product, how much inventory do we need to buy? How much raw material do we need? How many employees do we need to hire? What other kinds of things we may need? So these are the decisions that the business managers have to make in order to survive. Another thing is types of accountants. There are two types of accountants we talk about, the CPAs, the certified public accountant, and certified management accountant. So the certified public accountants do most of the things that are related with financial accounting, such as they prepare financial reports. So that's called financial reporting. They also do audit of the financial statement that we barely touch in the last course. They review those financial statements and tell whether they are presented fairly or not. They also do your tax returns, state tax returns, federal tax return, and sales tax return. The certified management accountants mostly work for what we have discussed in managerial accounting. So these managerial accounting, the CPAs also work here, and the CMAs also work here. So these people mostly do budgets, forecasting, and projection business. Accounting positions that we have available, we have accounting positions available in public sector. Public accounting basically do audit work. So you may have heard Big 4 accounting firms, or you may have heard Big 8 accounting firms. Those accounting firms mostly provide audit work, various kinds of audit work. They provide various kinds of tax services. They also provide other activities as well, but the major are tax and audit. Then we have publicly traded companies. We have privately closely held companies. The publicly traded companies such as Microsoft, Apple, Pepsi, Coke, these companies' shares are traded publicly. And in private firms that are closely held private firm, for example, in Texas, we have a firm called A1 Air. They provide HVAC service, mid-size business, but it's a private. Government has also accountant position. So they, for example, a state of Texas, city of Dallas, or a city of Fort Worth, Tarrant County, all of those entities use accountant. Non-profit, for example, March of Dimes, American Heart Association, they also provide, they also need accountants. So basically we have a non-profit accountants, governmental accountants, we have public accountants, and we have private accountants. All right, so the next thing we're going to talk about, professional framework. So professional framework is basically what it is the set of rules we follow. Now it says generally accepted accounting principles, or GAAP. So the accounting principles that we use, for example, for a burger joint would be different than what we use for Walmart, even though both are in retail sales. For example, we're going to use for oil and gas industry versus a company that produce movies. So they are different accounting rules apply. So the generally accepted accounting rules they are not hard and fast rules. They are rules allow to work in various situations. So what does is these accounting rules are formulated by FASB. So we have a institution called FASB. FASB provide GAAP, generally accepted accounting principle. So FASB wrote, Financial Accounting State Board write all the rules for GAAPs. So a GAAP is a set of rules that is understood by financial reports. So when a company says that I am producing my financial statement using GAAP, that means that they follow GAAP rules. You remember that in Accounting 2301 in financial accounting, we talked about there are two ways of making financial statement: accrual basis and cash basis. So when we are using GAAP, we are telling people we are doing accrual basis of accounting. So when an auditor look at your financial statement, it says that you have presented your accounting information according to the GAAP rule. You may have make your financial statement based on cash accounting, or if you want, you make your accounting your financial statement based on income tax basis of accounting and or regulatory basis of accounting, which is beyond the scope of this course, but I'm just telling you there are rules. But when you follow one set of rules, you have to follow all the rules in that set. So majority of the publicly traded companies offer or provide their reports, financial reports, using GAAP. All right. And then we have International Financial Reporting Standard. So this is called IFRS. Companies outside United States means that those are not American companies. They belong to 100 countries in the world, like India, Europe, Australia, New Zealand, some African countries, some European countries used. Instead of GAAP, they use IFRS, International Financial Reporting Standards, which is almost same like GAAP. And the organization that write those rules are called International Accounting Standard Board. Okay. The next thing that we have a financial oversight. So what does oversight means? Oversight means this institution, which we call Securities and Exchange Commission, SEC. It's a federal agency, basically focus interstate sales of stocks and bonds. Basically, SEC monitor publicly traded company. So if you have a closely held private company, they usually do not interfere how you run it. But when you are running a publicly traded company like Apple, Google, Microsoft, Pfizer, Pepsi, Coke, they like to follow you. So they are basically provide oversight that they are not making any material mistakes that could hurt the shareholders or the creditors of the company. Again, we just discussed FASB, so it's oversees creation and governance of accounting standards, and it reports to the Security and Exchange Commission. So FASB comes under SEC. So if you look at SEC as FASB provide GAAP rules, and this is how it goes over here. The next thing we're going to talk about is in this a non-governmental entity whose pronouncement established GAAP. So this is the job of the GAAP. The FASB provide all the codification and all the rules of the GAAP. Then there is a new thing that we have created around 2001, 2002. It's called Public Company Accounting Oversight Board. This Public Company Accounting Oversight Board basically audits the auditor. So they audit the auditors. Auditors such as E&Y, for example, who else we have? E&Y is one example. So why do they audit? So what happened in 2001? There was a financial crash. A lot of companies went down due to one of the most important and famous was Arthur Andersen and Enron. Enron was a publicly traded company. Arthur Andersen was their auditor. Arthur Andersen were hand in glove with the company. They did not provide all the information in their audit reports they're supposed to provide. And that's why after this debacle, the federal government created PCAOB to audit these auditors. So what happened? PCAOB audit these auditors who audit, say, more than 100 publicly traded companies each year. And if they're auditing only about 50 plus companies, they audit them every 3 years. You do not need to know this. Just know the abbreviation Public Company Accounting Oversight Board. So what are the organization and rules that govern accounting? So accounting guideline in the US is called Generally Accepted Accounting Principles, or GAAP. They have two major things that do. So they recognize and measured. So recognition and measurement. So what does it mean by recognition and measurement? Let me give you some idea. So the condition under which a particular asset, liability, revenue, or expense can be recorded in the financial statement. Like I said, every transaction is a unit of your business. So when you are recording as a revenue, so when you should recognize a revenue, when you should recognize your expense, when an asset is an asset, and when a liability is a liability. So we are going to talk about certain concepts. One is accounting entity. Accounting entity simply means the business that we're talking about. Accounting period. Accounting period means 1 month, 3 months, which we call quarter, or monthly reporting for 1 month, 6 month, and yearly. The most important are 3: month, quarter, and a year. So almost all companies provide you yearly financial statement. Publicly traded companies are required to provide quarterly financial statements as well. And a lot of companies also have a month-end closing period in which they provide their management at least that every month where we stand in terms of revenue, expense, and asset, liability, and equity. Monetary unit, simply remember that every country has a currency. For example, in US we use dollar, so all the financial statement must be denoted in dollar. So for example, if you put your financial statement without a dollar sign, so we do not know when you say revenue 1 million, what 1 million? 1 million peso, 1 million Canadian dollar, 1 million pound, 1 million euro, or 1 million US dollars. So this information needs to be mentioned, that the numbers that been provided in this financial statement is in US dollars. Going concern means, is this company going to survive the next 1 year? So when an auditor audits the report, one of the things they have to mention whether this company has a probability, or is it probable that this company is going to last 1 more year. So it's like a doctor telling a patient, will you survive the next 1 year or not? So this is the job of an auditor, to report in their audit report about whether this company is going to last or survive the next 1 year. The principles that we are going to talk about is the cost principle. Cost principle is also called historical cost principle. It simply means that if you have purchased something for $100, you're going to report it as $100. For example, you are buying a building for your company and you pay $100,000. So you put that $100,000. So that building, as long as the business owns, it will remain as $100,000. You will never change it. Even the market value of the building may change. So for example, you open a business, you purchase the shop for $50,000. 5 years down the road, the market value of the shop is now $230,000, but you will never change that. If you are using GAAP and historical cost principle, the asset would remain. So what's going to happen if you sell it? So if you sell it for, say, $320,000, you initially bought for $50,000. So 320 minus 50 is $270,000. That would be considered a gain on the sale of the shop. So that you will recognize once you sell it, as long as you have it, and then you will pay tax on the 320,000 gain that you have. But if it, even from 50,000 it go to 5 million, but it will remain in your financial statement as a $50,000 asset, you will never increase it. So keep that in mind. Revenue recognition is another important topic. Revenue recognition is when and how much revenue we're going to recognize. So for example, if you go to Walmart, you buy something for $10, you give them a $10, they give you the product. You're even. Walmart earned $10 in revenue, you got the product. But sometimes either we pay in advance or we pay later. So for example, if you are running a bakery and I come to your bakery and say, hey, I would like to buy a cake. And you say, okay, this is a $50 cake. And I say, oh, sorry, I forgot to bring my wallet. So I will give you the money tomorrow or next week when I come. And you say, oh, no problem. I know you and I know you will pay. So you can pay me next week. But since you have provided me a cake, but I have not provided you the $50, which I'm going to give you next week. So you have earned your revenue for $50 because I was happy with the $50 cake. Even though you did not receive it, you have earned a revenue of $50. And this will give a rise to your account receivable. I owe you $50, so this is an accounts payable for me, and for you account receivable because you have a claim on me for $50. The second situation is actually the third situation, in which I pay you money in advance and I say, hey, I want you to make a very beautiful birthday cake for my friend, and that cake may cost $100. And I say, here is $100. You make the cake and please deliver the cake in 2 weeks from today. So until you deliver the cake, this $100 is not your revenue if you are using accrual accounting and if you are using the expense recognition revenue recognition principle. So once you deliver the cake and I'm happy with the cake, at that point you can say you have earned that $100 and that $100 is your revenue. Expense recognition is also called a matching principle. It simply means that we have to recognize how much expense you have incurred to earn this much revenue. So for example, the cake that you are giving me for $100, right? So that $100 cake cost you to make like $40. So your cost of making the cake is $40, and you are selling it for me, selling it to me for $100. So you will say it cost me $40. So your cost of goods sold is $40 and your revenue is $100. So your gross profit on this transaction turns out to be $60. All right. And what does full disclosure means? Full disclosure simply means you are going to disclose all the information that a reasonable person need to read and understand your number. As you know, the income statement, the balance sheet, statement of retained earning, and a statement of cash flow has a lot of numbers. And sometimes in order to understand these numbers, you have to provide some information, some related information. That is considered a full disclosure. Okay. The next thing is basically we again talking about the assumptions and principles. One of them is called entity assumption. Entity assumption, like I discussed earlier, an organization stands apart from other organization and individual as a separate economic unit. So for example, Walmart. So suppose you go to Walmart and you slip and you hurt yourself, you end up in a hospital. Now you want to sue the Walmart. So Walmart is a corporation, is an entity. So when you are suing Walmart, you're not suing me as a shareholder or owner of that. So a Walmart is separate from its owner. So that's the entity exemption talk about. The same again, continuity or going concern assumption that entity will continue to operate for the foreseeable future. In United States, it is 1 year. Historical cost principle, again, the same cost per asset should be recorded at their actual cost on the day of purchase. Monetary unit, assume the dollar purchasing power is stable over unit. That's what our understanding is. So we are going to stop this this video here, and then we're going to start the later part of this course in the next video.